Residential Market Analysis and Highest and Best Use. Chapter 1, Market Fundamentals, Characteristics and Definitions. Page 20, Opportunity Costs. This principle relates to the advantages of an alternate investment. The rates of return for a real estate investment are compared to the rates of return for other types of investments. Will the other type of investment yield a greater rate of return than the present planned investment? Will the investor be content with the long-term return on the present investment? What is the cost of foregoing one type of investment for another? Selecting one type of investment over another ties up funds that could have been invested in other opportunities. The investor will analyze the given situation and position to best fulfill his or her investment strategies and provide an acceptable rate of return for the initial investment. Different investors have different strategies and require more or less return for their investment. Some investors require a higher rate of return because of a greater investment risk. Other investors look for more sustained growth over time and are willing to accept a more conservative rate of return for their investment. The question becomes one of individual strategy on the part of the investor. Is the investor willing to gamble with a greater investment risk for the prospect of a higher rate of return? Should the investor play it safe and take a secured investment for a more conservative but more assured rate of return? These are questions that only the investor can answer, and the answers depend on the liquidity of available funds. The principle is that only the investor can answer. And the answers depend on the liquidity of available funds. This principle closely associated with the appraisal of income producing properties and the analysis of highest and best use. This principle is related to the following principles: competition, 4 agents of production, substitution, supply and demand. End of page. Page 21, progression and regression. When a property is inferior to those surrounding it, its value will be enhanced by the presence of the superior properties. Using an extreme example, one can visualize the worst house in terms of condition in a good neighborhood. That value of the house in the good neighborhood will be influenced by the other homes in that neighborhood. If that worst home were in a neighborhood of homes in average to fair condition, the value of the worst home would be much lower. In this case, the home's location will keep the value from going lower because of the surrounding good neighborhood. An investor would be willing to pay more for the worst home because of the anticipated profit from putting it into a condition similar to the other houses in the good market area. The same thing is true for a superior property located among inferior properties. The superior property will tend to suffer a loss in value due to its location among the inferior properties. This generally occurs as a result of the market interaction of dissimilar properties, which are recognized as non-conforming for a particular market area. For an example, let's consider two houses in an identified neighborhood. We can visualize the first home, which is conforming to the market area. The market indicates that this property is typical of the neighborhood and is worth $100,000. The second property is not typical for the identified market area. In its own neighborhood, it would be worth $200,000. A typical buyer may be willing to pay a little more than $100,000 for the second property, but certainly not $200,000. The $200,000 property is non-conforming to the neighborhood. In other words, the neighborhood will not support the value of $200,000 for this property because it is over-improved for the identified market area. The value of the $200,000 property has regressed because of the influence of the property values typical for the market area. This principle is related to the following principles: conformity and externalities. End of page.